The sell wall didn't just crack. Silver forced its way through it, flashed the $80 handle, and then the market tried to slam the door in your face with the oldest play in the book: margin, volatility, and forced liquidation dressed up as profit-taking. That's the conflict right now. One side needs this move to look like a random spike so you stop paying attention. The other side is being dragged into buying they didn't want to do, at levels they swore would never print. And the part most people are missing isn't the headline price at all. It's where the stress showed up first, under the surface, and the mechanics that decide whether a breakout becomes a new regime or just a spectacular bull trap. Stay with me, because by the end you'll have a near-term roadmap. What levels matter, what confirms the thesis, what would weaken it, and the exact tell that usually shows up a few sessions before the next violent leg. And that's where the real pressure starts. Here at Wording's what you have to accept up front. The market can whip you around even when you re-directionally right. Silver just proved it. It surged into record territory, tagged the $80 zone, then snapped back hard into the low 70s. That doesn't invalidate the move, it explains the battlefield. In silver, the most aggressive rallies don't end with applause. They end with risk desks turning the leverage dial down, liquidity thinning, and weak hands being ripped out, so the next phase can begin with fewer passengers. But that's not the part that matters. The part that matters is why the sell wall failed in the first place. Because sell wall is not a mystical barrier. It's just the visible edge of positioning, inventory, and hedges pretending to be stable. And when the wrong kind of buyer arrives, price-insensitive flow, urgent physical demand, or reflexive dealer hedging, that wall becomes a trap for the sellers themselves. Because if this one level breaks, the math changes. Let's translate the title without turning it into a conspiracy cartoon. When people say banks panic, what they usually mean is dealers and large intermediaries are suddenly managing risk in a way that creates feedback. They aren't sitting around plotting. They're staring at exposures, collateral, and volatility metrics that can force them to hedge or de-risk on a schedule. That matters in silver more than most assets because silver is a hybrid beast. It trades like a monetary metal when fear rises. It trades like an industrial input when growth and electrification narratives heat up. And it trades like a leveraged volatility product when options positioning stacks at obvious levels. That combination is why the tape can go vertical and then slap back like it hit a rubber wall. And that S also why a simple S up because people are bullish explanation is useless. The move is not emotion, it's plumbing. And the next detail is what flips the whole setup. Think about the $80 zone psychologically. Round numbers in commodities become magnets because they align strikes, stop placement, and narrative. The moment a market approaches a round number, you get an ecosystem of behavior. Some sell because they know it won't break. Some buy because they want the breakout. Options flow clusters because it's easy to understand and easy to sell as a story. Dealers hedge because they don't want directional exposure. And large hedgers roll risk because they have calendars, not feelings. That creates a false sense of a wall. A thick layer of resting, sell interest, plus defensive hedging. But the wall fails when the buying isn't optional. When buying is mechanical, when it's forced. And the moment silver accelerated through that zone, you saw the signature of forced behavior. That's why the breakout matters more than the intraday retrace. Because the market can unsee a rumor. It can unsee a structural shift in how risk has to be managed. And that's where the real pressure starts. Now I'm going to give you the hidden detail early. Because if you only watch the spot chart, you'll get emotionally manipulated. The hidden detail is that when a breakout is real, stress appears first in the cost of time and the cost of access. In plain English, the curve and the borrowing. The term structure, how near-month contracts price versus later months, starts to behave differently when the market needs metal now, not later. And the cost to borrow or source metal through lease rates, location premiums, and physical availability signals starts to tighten. You don't need to pretend you have perfect data to understand the mechanism. You just need to know what to watch. When the curve tightens and the urgency shows up, it forces behavior. Arbitrageurs have to move material or move risk. Fabricators hedge differently. Dealers manage inventory differently. And speculators who thought this was just a chart suddenly realize the market is pulling forward demand. But that's not the part that matters yet. The part that matters is how the hidden stress links directly to the way the 80 sell wall broke. So let's do the mechanism explainer without getting academic. There are two engines that can push silver through a wall: physical pull tension and options reflexivity. Sometimes you get one. Sometimes you get both at once. When you get both at once, you don't get a gentle breakout. You get a launch, followed by violence, followed by either a regime change or a trap. This move had the fingerprint of options reflexivity right at the moment the market got close to the big number. Here's the simplest version. When lots of call options are bought around a level, the dealers who sold those calls often hedge by buying the underlying futures. Their hedge ratio, delta, changes as price moves. And when you're near a strike with a lot of open interest, the sensitivity, gamma, can become the dominant force. In a high gamma environment, a rising price forces dealers to buy more to stay hedged. That buying itself pushes price higher, which forces more buying. It's reflexive. It's not a theory. It's risk management. And when liquidity is thinner, like year-end, it takes less flow to move the market further, faster. And that's where the real pressure starts. Now connect that to sell wall. The sell wall is often built by two groups, people leaning on a level short, and hedgers who place offers because they believe they can absorb demand. But the moment dealer hedging turns into an automatic bid, the wall becomes unstable. Sellers who thought they were selling into normal demand suddenly sell into a bid that grows as price rises. That is the opposite of what they planned for. And when the market prints through the level, the psychology flips. Stops trigger, shorts cover, momentum systems join, and suddenly the sell wall isn't supply. It's future demand, because anyone short above a broken level has a problem, and the market knows it. But here's the twist. Silver is leveraged, leverage is fragile, and exchanges don't need to ban anything to cool a market. They just change the collateral requirement. That's why your calendar matters more than your conviction, because the calendar is the catalyst. Year-end is not a normal time. Liquidity gets weird, dealers widen, books get cleaned up, funds rebalance. And risk managers get aggressive because nobody wants to be the person who carried an outsized high volatility exposure into a reporting boundary and got punished for it. So when a market like silver goes vertical into year-end, two things tend to happen. First, volatility rises because the order book thins. Second, the system responds by making leverage more expensive. Margin requirements rise. That's not a conspiracy. It's how clearinghouses protect themselves when daily swings expand. And that matters because margin hikes create forced selling, even from people who are right. If your collateral can't support your position size, you sell. Not because you changed your mind, because you have to, and the market uses that as a weapon. That's the volatility trap. And that's why the move from above 80 down into the low 70s can happen without the underlying story being over. But that's not the part that matters. The next detail is what flips the whole setup, whether the structure underneath relaxes or stays tight. So let's build the proof stack the way a skeptical metals crowd demands it. Not one argument. 5 layers. Mechanism, structure, flows, real-world symptoms, and what to watch next. Layer 1 is the tape itself. Silver didn't just drift into the $80 zone. It surged and printed extremes, then snapped back. That is classic leveraged commodity behavior when positioning meets a calendar boundary and the clearing system tightens the screws. Layer 2 is the policy reaction of the market structure, margin requirements, rising after a volatile week. That is the system acknowledging that price risk expanded. Layer 3 is the curve and spread behavior, whether near-dated contracts trade with urgency relative to later months. Layer 4 is physical tightness proxies, borrowing costs, location premiums, retail availability chatter, and industrial procurement behavior. Layer 5 is institutional flows, who is buying in a way that doesn't care about the perfect entry. And if those layers align, the sell wall failure is not a random spike, it's a transition. But if they don't align, if the curve relaxes, tightness fades, and flows reverse, then the breakout can decay into a brutal consolidation. And that's where the real pressure starts. Let's talk about the curve in human terms. In a calm market, time is cheap. You can buy later. The forward curve will reflect storage, financing, and convenience yield in a relatively stable way. But when a market needs metal now, the front of the curve starts to behave differently. The near month can get stronger relative to deferred months because immediate access has value. That S1 of the cleanest, paper versus physical, tells you can watch without pretending you have inside information. If the front stays firm, even when spot pulls back, that means someone still needs exposure now. If the front collapses and the curve relaxes, the urgency is fading. And that distinction matters this week because it tells you whether the sell-off was just leverage being wrung out or the whole market changed its mind. But that's not the part that matters. The next piece is what it forces participants to do. If you're an arbitrager and the curve signals urgency, you can't just shrug. You either deliver metal, source it, or you roll exposure differently. If you're an industrial user, you may pull forward purchases to avoid paying more later or to ensure supply continuity. If you're a dealer, you manage inventory and hedges differently because your risk profile changes when the market is backwardation prone or when deliverable float becomes the constraint. And if you're a short who leaned on the $80 wall expecting it to hold, a curve that stays tight is bad news because it means the market isn't only driven by paper excitement, it's being pulled by near-term demand for exposure. That's how squeezes become durable. Not because everyone believes, because the market structure forces behavior. And that's where the real pressure starts. Now, physical tightness proxies. You have to be careful here because this is where people start inventing numbers and making dramatic claims. Don't do that. What you want are directional signals. When borrowing costs rise, when location premiums widen, when you see persistent reports of higher premiums for certain products, when you hear that lead times are extending, those aren't perfect data points. They are symptoms. They matter because they tell you the marginal unit of silver is being bid for, not offered. And the marginal unit is what sets price in tight markets. If the marginal unit is hard to access, the paper market can trade at a discount to what urgent buyers are willing to pay. That tension doesn't always show up as a clean, permanent premium. Sometimes it shows up as recurring spikes, dislocations, and sudden short covering events. The mainstream will call that volatility. The informed viewer calls it stress, but that's not the part that matters. The part that matters is the difference between inventories that exist and inventories that can actually hit the market. In metals, not all inventory is equal. Some inventory is sitting in a place and form that can be delivered into futures mechanisms quickly. Some is sitting in a place and form that is economically sticky, owned by someone who doesn't want to part with it, or tied up in logistics, or held for long-term strategic reasons. If you don't separate the idea of total inventory from deliverable float, you'll get confused at the worst time. Because a headline can scream, inventories are high, while the deliverable portion is tight, or while the effective float is controlled by holders who won't sell into a rising tape. Again, you don't need perfect numbers to understand what to watch. Watch for persistent stress in near-dated spreads. Watch for repeated episodes where price tries to dip and is bought aggressively. Watch for any sign that deliveries and warehouse categories are shifting in a way that reduces deliverable availability during high demand. Those are the tells. And if those tells persist, a pullback is not a signal to panic. It's a normal phase where leverage is reset. But that's not the part that matters. The next detail is what institutions do when silver goes from boring allocation to front-page volatility. Institutional flows in silver are deceptively powerful because a chunk of demand comes from vehicles that buy when investors allocate, not when the chart is pretty. That's the price-insensitive bid. If money is moving into silver-backed products, it can tighten the ecosystem because those vehicles source metal or hedge exposure in ways that remove supply from the marginal market. Combine that with industrial demand that doesn't disappear just because price is volatile, and you get the kind of tug-of-war where paper shorts can get trapped. This is where skeptics push back and say, it's all speculation. Fine. Even if it is heavily speculative in the short run, speculation still interacts with inventory constraints, curve dynamics, and hedging mechanics. Markets don't care whether you think a rally is deserved. They care who is forced to do what at what time. And right now, the timeline matters. Because this is a year-end to early January transition where positioning resets. And that's where the real pressure starts. Now layer in industrial demand without turning it into a fairy tale. Silver's industrial use is real, and it's not evenly elastic. Certain applications can thrift or substitute over time, but not instantly. Procurement is done on schedules. Manufacturing runs on lead times. And if a large chunk of the narrative this year has been AI infrastructure, electrification, and the build-out of power and data systems, silver sites in that ecosystem as a critical conductive material. The point is not industry guarantees price. The point is that industrial demand can make dips behave differently because it represents a baseline of consumption that doesn't turn off when traders get nervous. When you combine baseline consumption with investment allocation and options reflexivity, you get episodes where price overshoots and then retraces violently, but the underlying bid doesn't vanish. It goes quiet. It waits. And then it hits again when the market gives it access. But that's not the part that matters. The next part is the counterpoint you need to respect if you want to keep your credibility. Here's the counterpoint. Parabolic moves often retrace deeper than people expect, even in bull markets. Not because the bull story is dead, because the market has to punish leverage, silver especially. When margin requirements rise, it changes the entire short-term demand curve for futures exposure. Traders who were comfortably margined suddenly aren't. Funds with strict risk limits have to reduce. Some participants sell winners to meet collateral calls elsewhere. And that creates a cascade where price falls fast enough to convince late buyers the story was fake. That's how the market resets positioning. It's also why you cannot marry the exact path. You can be right about the regime and still get destroyed by the route. The route is violent, and it's designed to make you emotional. Which brings us to the viewer psychology shield, because this is where most people lose money without realizing it. Your brain will be attacked in 3 ways in a silver market like this. First, the headline attack. Silver crashes, blow off top, bubble pops. Those headlines are written to convert your attention, not to protect your capital. Second, the candle attack. A single huge red bar makes your nervous system interpret risk as imminent danger, even if that bar was driven by margin mechanics rather than fundamental reversal. Third, the social attack. The loudest voices become the most confident, either screaming to the moon or screaming, "It's over." And both extremes push you toward impulsive action. Your defense is to separate trend signal from noise. Trend signal is structural. Does the market hold higher zones on retests? Does the curve remain firm? Does the system keep showing tightness symptoms? Do flows persist? Noise is path. Intraday spikes, liquidation wicks, one-day collapses triggered by leverage. If you can't tell the difference, the market will use you as liquidity. And that's where the real pressure starts. Now let AUS get concrete about the levels and the roadmap without pretending we can predict tomorrow, get a yeast candle. The obvious battlefield is the $80 zone because it was the line everyone saw. And now that it printed, it will keep influencing behavior. Below that, the next psychological area is the $70 handle, because that's where the market already snapped toward after the peak. Between those, you have the Sindilin Ontus failed sell wall band, the upper 70s into 80, where retests will tell you everything. A healthy regime shift doesn't require price to live above $80 every minute. It requires that when price revisits that breakout band, sellers fail to push it back into the old cage for long. It requires that dips are bought with urgency rather than with hesitation. It requires that rebounds are not just thin, short covering, but are supported by structure, spreads, curve, and continued signs of demand. And if the market can't do that, if it slices back below the band, churns, and starts making lower highs with a relaxed curve, that is your warning that the move is digesting or potentially reversing. But that's not the part that matters. The next detail is the two scenario lens that keeps you sane. Scenario one is the controlled pullback and retest. In this scenario, the market respects the 70s as a new higher zone. Volatility stays elevated, but becomes more two-sided. And the next push happens after leverage has been reset and positioning has cooled. What confirms scenario one? You see dips get absorbed. You see price fail to spend much time below the key psychological handle. You see rebounds that don't instantly collapse. And importantly, you don't see the structure completely relax. Front-month behavior stays relatively firm, and the need it now signals don't vanish. What weakens scenario one? A slow, heavy grind lower with no snapback, combined with a clear relaxation in the curve and easing tightness symptoms. Scenario two is the continuation squeeze. This is the violent one. This happens if the sell-off was primarily margin-driven liquidation and the underlying drivers remain active. So the market rebounds into thin liquidity, triggers more dealer hedging, and forces trapped shorts to cover into a rising tape. In scenario two, you can get gaps. You can get limit-like moves. You can get another sudden confrontation with $80 and above. What confirms scenario two? Speed, a rebound that refuses to give you the perfect entry. A fast reclaim of the breakout band, renewed upward acceleration into strikes and obvious levels, and again, structure that stays tense. What invalidates scenario two? A rebound that looks strong for a day or two and then fails immediately with expanding selling pressure and calming volatility. And that's where the real pressure starts. Now, let's address the phrase banks panic with the right frame. In a move like this, dealers can be effectively short convexity if they've sold calls. That doesn't mean they're short silver because they hate silver. It means their options book exposes them to rising price in a way that forces hedging. If price rises through high open interest strikes, their hedges can require them to buy into strength. That's why rallies can accelerate right when everyone expects resistance. Then, margin hikes arrive and the forced behavior flips. Leverage long sell, volatility spikes, and the market whips. But the dealers still have to manage their book. If the market stabilizes and starts rising again, then reflexive hedging can come right back. So the panic is an emotion. It's that the market is forcing participants into actions they didn't choose, on a timeline they didn't control. That always was why you should care more about the next 2 weeks than about the last 2 hours, because the calendar is still active. Here's the why now trigger in plain terms. We are at a time when liquidity has been thin, year-end constraints have mattered, and the market has already proven it can move multiple dollars in a blink. Margin adjustments change behavior into early January. Funds and desks that reduced risk into the year-end boundary may re-engage once books reset. Meanwhile, industrial and strategic buyers don't stop existing because the calendar changed. This is where you can see the classic pattern: a violent peak, a violent liquidation, then a quieter grind that builds a platform until the next catalyst hits. That catalyst can be an options expiry window, a delivery window, a macro headline that moves rates or the dollar, or simply the market realizing that supply access is not as abundant as the paper price implied. But that's not the part that matters. The part that matters is what you can monitor without guessing. So here's your near-term checklist, translated into what to watch next week language. Watch whether silver can reclaim and hold the upper 70s on a closing basis rather than just spike there intraday. Watch the behavior around the $70 handle. Does it act like a trampoline or a trapdoor? Watch volatility behavior. Does it stay elevated but start compressing as price stabilizes, or does it expand on down moves more than up moves? Watch for signs that spreads and near-term pricing remain stubborn even when spot pulls back, which would suggest underlying demand for near-term exposure. Watch institutional flow cues. Are investors still allocating into silver vehicles, or is there a pause? Watch macro crosswinds. If the dollar strengthens sharply or real rates jump, silver can face headwinds even if the structural story is intact. And most importantly, watch your own behavior. If you find yourself needing the market to go up today to feel okay, you're sized wrong for this asset. Silver punishes impatience, and that's where the real pressure starts. Now let's talk about what would actually weaken or invalidate the broader bullish regime idea, because credibility is built by defining what could prove you wrong. 1. If the market falls back and spends sustained time below the post-peak zone and rallies become shallow and easily sold, that suggests the breakout was more speculative than structural. 2. If the curve and tightness proxies visibly relax, meaning urgency disappears, then the hidden detail is no longer supporting the narrative. 3. If institutional flows reverse meaningfully and the market loses its price-insensitive bid, then the rally becomes more dependent on speculative momentum, which is fragile. 4. If macro conditions shift violently against metals, sharp tightening in financial conditions, a sudden surge in the dollar, or a shock that forces broad de-risking, silver can drop hard even if longer-term drivers remain. In that case, the right thesis can still produce a brutal drawdown before it reasserts. That's not fun, but it's real. And if you can say that out loud, you'll make better decisions, because the market can be correct and cruel at the same time. Now, let's flip back to why the sell wall failure is still important even after the drop. The market did something it wasn't supposed to do. It printed above a level that was defended and psychologically dominant. That matters because it changes how participants anchor. The next time the market approaches that band, fewer people will confidently sell it just because it's impossible. Some will sell, yes, but the confidence is dented. And when confidence is dented, liquidity at that level can be thinner. Thinner liquidity means larger moves on similar flow. That's how volatility regimes shift. This is why you'll often see a market tag, a historic level, reject, and then come back later with more force after the system has been rebalanced. The first touch is discovery, the second touch is decision. And the space between those touches is where you either build a base or you build a trap. But that's not the part that matters. The next detail is the trap that gets most viewers. The trap is thinking you need a single perfect narrative. You don't. You need a decision framework. In a market like this, the narrative will be constantly rewritten. One day it's industrial demand, the next day it's speculation, the next day it's manipulation, the next day it's margin. Most of that is just people trying to explain volatility after the fact. Your job is simpler. Identify the forces that are mechanical and therefore repeatable. Options, hedging is mechanical. Margin dynamics are mechanical. Curve and spread signals are structural. Physical access symptoms are real world. Institutional flows are observable over time. Behavioral panic is predictable. Those are your anchors. Everything else is noise designed to pull you off your plan. And that's where the real pressure starts. So where does that leave us right now in one sentence? Silver proved it can trade in the $80 zone, then got hit by the leverage reset, and the next phase will be decided by whether the market holds a higher platform in the 70s and rebuilds pressure into the breakout band, or whether it bleeds back into the old range and relaxes the hidden stress signals. That's it. No magic, no guarantees. 2 scenarios, a few levels, and a structure checklist. If you want an actionable way to think about it without crossing into advice, think in horizons. If you're a short-term trader, your entire life is volatility and levels. Upper 70s into $80 as the reclaim zone, the low 70s as the battle, and the $70 handle as the psychological line in the sand. If you're a macro watcher, you care about whether this is a new regime where silver is repricing alongside broader monetary and industrial themes, which would show up as persistent allocation interest and repeated buying of pullbacks. If you're in the metals crowd because you distrust institutions, then your focus should be even more disciplined. Don't get hypnotized by narratives of certainty. Watch the incentives and the mechanics. The market doesn't need a villain to behave violently. It just needs leverage and thin liquidity. And you just watched both. But that's not the part that matters. The next detail is the quiet warning. I want you to remember the next time you see a giant red candle. Volatility will be used against you, even if the thesis is right. The market's job is to extract emotional mistakes. In silver, the extraction method is speed. It spikes to make you chase, it dumps to make you capitulate, it stabilizes to make you bored. Then it moves again. Your shield is simple. size small enough that you can think clearly and use structure to decide, not adrenaline. If the market holds key zones and the hidden stress signals persist, you don't need to panic on a liquidation wick. If the market loses structure and the signals relax, you don't need to rationalize. You just acknowledge the environment changed. That is how you stay solvent and sane in an asset that can be right and terrifying at the same time. And that's where the real pressure starts. Now I'll close with the cleanest near-term roadmap I can give you. Base case, silver digests the move, holds the low to mid 70s region with violent swings, and eventually challenges the upper 70s and $80 again once the leverage reset is absorbed and liquidity normalizes after year-end. Confirmation? Repeated dip buying, quick recoveries, and no prolonged breakdown below the psychological handles. Invalidation, sustained trade well below the post-peak platform, weak rebounds, and clear relaxation in structural stress. Squeeze case, silver rebounds fast, reclaims the breakout band, and the options and short covering engine reignites in thin liquidity, turning the next push into another sharp confrontation with $80 and beyond. Confirmation, speed, refusal to offer clean entries and renewed acceleration through obvious levels. Invalidation, a reclaim that fails quickly and turns into heavy selling with calming structure. If you keep those two scenarios in mind, you'll stop being surprised by the violence and start using it as information. And here's the subtle community call, because this market rewards people who think in mechanisms, not memes. If you're the kind of investor who wants the plumbing, the incentives, and the what would change my mind checklist, not just the loudest narrative, stay in this lane, track the structure, share what you're seeing in the spreads, the curve, and the behavior around the key zones. Because the next move won't be announced with a headline. It will be telegraphed by pressure under the surface. And when it shows up, the market won't give you time to debate it.